Gaurav, deal activity in the wealth management space keeps rising, except the value of the deals has been moderating. So what's actually going on with M&A in the wealth management space?
So unlike other sectors where the deal activity has been choppy, when you look at wealth and asset management, it has been the provider of momentum for financial services deals. And you look at the wealth and asset management space, there are nuances within each segment, but the common theme is deal economics or the balance sheet economics. If you look at wealth management, what has been a primary driver of deals so far has been private equity activity. But recently that has now moved into focus on more long-term durability, looking at organic growth and providing operating leverage at scale. That's what deals are chasing. On the asset management side, the focus of the deals we all know has been on the private market side. So a lot of focus on private credit, on infra, and the underlying assumption is there would be an expansion on the fee-related earnings. That's what is driving the deal volume. The last thing I would say on this is there has been a change in era. Now, firms are chasing not just asset accumulation, but deal economics or better balance sheet economics as well.
Can you dig a little bit deeper about the blurring line between wealth management and asset management and what investors in these deals really want?
Yeah, so when you look at it, there has been a sea change in terms of the way firms think about operating in this segment. There has been a move from a product-led thinking to a focus on orientations to enable client outcomes. For wealth managers, what this means is advisors are seen as primary relationship owners who are managing relationships with clients. And platforms are enabling these relationships by embedding tools as a part of the platform of the advisor framework. You look at asset managers, what they are doing also, they realize that just pushing product distribution is not enough. In addition, they need to participate with these wealth platforms through tax optimization, through model portfolios, as well as through alternative access. In short, there is a confluence between wealth and asset management. And now this is clearly we are operating in a space where you are having blurred lines.
And how is AI moving the needle? How is it making things more efficient on both the wealth management side and the asset management side?
You look at AI, there can't be any conversation which doesn't touch upon AI. When you look at where firms which are winning the AI implementation journey or the race is where executives are personally involved. They're not just delegating to a technology team. They are personally looking at not just AI adoption, but the second and third degree impact of these AI tools, which can range from decision rights. It can also change the way your workflow manages or operates today and in the future, as well as the platform economics. You look at what wealth management firms are doing to implement that. What they are doing is they're looking at smarter referral, smarter advisor support, advisor productivity tools. And when you juxtapose that with asset managers, they're looking at using these technologies to improve portfolio construction. They're also looking to improve things like research workflows. So in short, a lot has to be proven yet, but one thing is clear, that built-in for AI would be beating bolt-on.
What are your expectations for deal making when it comes to private equity in 2026? Because all the money that's flowed into the wealth management space from giant private equity players has really changed the game. So what are your expectations going forward?
The expectations remain. This is a very attractive space. So private equity investing in wealth management firms, I do not see that trend to subside. But what I do expect the focus to change from just, as I was mentioning, it's not just simple focus on asset accumulation. It's also enabling balance sheet durability, because it's just having earnings growth and focus on that is not enough. Backing stronger balance sheet along with that is the name of the game. And also when you see on the asset management side, private equity firms are looking at improving their margins and also having more fee-related earnings. So the focus on private markets and having more of a overlay into private credit infrastructure remains. So still, I would say very attractive space, just the dynamics changing a little bit, and balance sheet being as equally important as earnings.
So finally, we've talked about capital, we've talked about technology. Is there any other thing that investors in this space, or even wealth managers seeking to sell their practices, need to know or should be focused on?
We talked about capital, we talked about balance sheet, we talked about earnings, we talked about deals. The one thing that I cannot avoid talking about is talent, because when you look at wealth management, it remains a people business. Regardless of the promise of AI, it would still be a people-first business. When you look at these firms which are growing, they're really ambitious growth goals, 3 to 5x growth in the next 5 years. What that means is if you're looking as an investor, you're not just looking at the capital deployment, you're also looking at the pool of talent. And you're looking at these combined firms which are growing, not just attracting advisors, but also firms through inorganic growth. What that means is these larger firms will have former CEOs working with them. How do you make them stick beyond just the earnouts and create a platform that can grow for the long term? That would define like the winners versus the haves versus the have-nots. So clearly, one thing that is clear in my mind is growing assets is financial, but growing talent is institutional.
All right, well, thanks for coming on and talking about it.
Thank you, Craig.